Hey guys, Kevin Bupp here, and I want to welcome you to another episode of the Real Estate Investing for Cash Flow podcast. Our mission is to help you build and maintain massive amounts of cash flow through income-producing real estate investments. Now, our guest for this week's show is real estate and capital gains deferral expert, my good friend, Brett Swartz. Now, Brett is the founder of Capital Gains Tax Solutions and is considered one of the nation's most well-rounded experts when it comes to capital gains tax deferral, which, really should be top of mind as we are recording this on April 18th, the deadline for your 2021 tax returns. And if you had a good 2021, if it was a good year for you, this is a real estate podcast, so if it was a good year for you in real estate, and this is not just going to be related to real estate because this strategy can be utilized for things outside of real estate, but again, if you had a good 2021 in real estate and you didn't have a solid tax plan in place, then you're probably finding yourself stroking a big check to Uncle Sam right now, which isn't a fun thing to do. So, guys, in addition to running his business, Brett is also the host of the Capital Gains Tax Solutions podcast, and somehow he still has time to be a great husband to his beautiful wife, Melanie, and father to 5 incredible children. So with that, guys, it's my honor to welcome my guest for today's show, Brett Swartz. Brett, how's it going, my friend?
Kevin, it's so good to be with you today and excited to be back on the show.
Yeah, excited to have you back here. I was just looking. I was trying to find the dates when I had you last on. It's been a while, man. It's been before the pandemic. So glad that all is going well with you and your family, your life. Things are awesome. We spent some time down here in Florida. It's been about a year now, which is crazy. It didn't seem like it's been that long, but excited to have you back on the show here. And Brett, for those that aren't familiar with you, maybe let's start with you taking the mic back and tell us a little bit more about yourself, your background, and ultimately how you found your way into the tax deferral world.
Yeah, I grew up learning real estate at a young age with my parents, buying and owning and developing real estate, mostly single family homes in the Bay Area. And this is the late 1980s, early 1990s. And so fell in love with being like an entrepreneur and owning real estate and learning about ways to grow wealth in a way that is different than maybe more the traditional W-2 ways. Fast forward, I went to college, had a chance to play some college athletics, as well as learned at a place called Marcus & Mills. I took an internship there, and we studied in how to help people buy and sell investment real estate. In particular, multifamily was my specialty, and so I fell in love with that. And this was in like 2006, okay? And things were going pretty good for a little while. The market came to a crash in 2008, and I looked around trying to figure out how am I going to make it in the business. I love the business, but my wife, and at the time, baby on the way, we're in a really, really tough part financially. And so you do whatever kind of real estate entrepreneur or investor wannabe does, you get a side hustle. And so that's where I side hustled at a place called Cheesecake Factory. And by day I'd make cold calls and trying to negotiate with banks on behalf of clients and or reposition properties for my clients. And by nights I would church at Cheesecake Factory to try to keep the lights on. And during this period of time, my clients were going through their financial struggle, which was losing some lost all of their wealth because they had too much debt, not enough liquidity, not enough diversification. They had felt trapped by the 1031 exchange handcuffs and had overpaid for some property. And our side, we're going, there's got to be a better way. And that's when we learned about the deferred sales trust. And I fell in love with capital gains tax deferral as a way to exit well, right? And have what's called optimal timing when you do that. And so I started just to apply the strategy, and I just started to talk to people, and people laughed at me, and people said, sounds too good to be true. Sounds like it's not legal. Sounds like it won't work. Sounds like you guys don't have a track record. And at the time I really didn't have a track record. And I wasn't sure if it was that good to be true, but I believe that it was the Netflix or the Blockbuster way of exit planning. And so I just continued to educate myself and study underneath the tax attorney, who's my business partner, and CPA, who to me is like the Bill Gates of tax deferral. Like he's that brilliant and that amazing. And fast forward, I had like the 6,000 or 7,000 hours of time with him. I started to send him referrals. Deals kept closing. It kept working. We kept overcoming the objections of the CPAs who thought it was too good to be true, or they would have known about it. And my business started to grow. I was able to retire from the Cheesecake Factory. My wife, now has 5 kids. She's able to stay home full time. And now I just teach and train and coach people how to do this. And we close about a deal a week these days. And I love it. And I think the time like this that's going on with all the stats and all the things that are changing, it's more important than ever as we work through what's called a tax flow versus just a cash flow, right? Cash flow is important, right? But I'd say it's even more important to have a tax flow plan in place so that you're not getting hammered when you exit.
Yeah, no, fantastic. And I appreciate that, my friend. I what's your website? And I don't recall seeing this on your website, but the 10 interesting facts about Brett. So I want to hit on a couple of those real quick before we roll into what is a DST or deferred sales trust. And one of those things I saw on there, Brett, number one, it's awesome that you married Melanie, your high school sweetheart. That's a pretty cool story. Like that just doesn't happen that often anymore. Again, the father to 5 amazing kids. But you're what? You're 5'11", 6 foot. How tall are you, Brett?
6 foot, 6 foot.
Okay. You rounded up. I got it. But you can dunk a basketball. Can you still dunk a basketball? I see you on
Not
here.
now. Okay. But I could. In high school, I could dunk on a good warm up, and then in college, I could dunk. And then I blew my ACL out, and then I came back and I could dunk again. So, but that was, senior year of college. But those days are past me now.
I love it. So that's one interesting fact that I saw on his web. But the other one is, you were running, basically as a kid, you were running an underground barbershop hustle, basically in your neighborhood, you and your brothers cutting hair of the neighborhood kids, charging them $5 and $10 a pop, right? I love that.
Yeah, we felt my mom was a hairdresser, right? And she would cut our hairs, and we just watched her, and then we started to do it, and then we became good at it, and then all the neighborhood kids would come over, and they start to pay. The parents were so happy with our results, they started paying us, and so we would just host 2 or 3 hour sessions, once or twice a week, and people would come over and we'd cut the hair, and it was fun. We did that all the way through college too, for all of our cousins and friends, and yeah, it's guys' hair is also easier too. It's not girls' hair, you know what I mean?
You're deep rooted entrepreneur. I love it, man. I love every bit of it. So let's get into the DST. First and foremost, what is it? And most folks are familiar with I guess the standard, the 1031. Pretty much anyone that's in real estate knows what a 1031 exchange is. And so let's really talk about just the DST, deferred sales trust. What is it? Let's start there, and then we'll roll into the more details.
Yeah, so a deferred sales trust is just an installment sale that's specialized and or partnered with a business trust. So it's combining two aspects of something you might be aware of, and it's making it a way to defer capital gains tax. First of all, it's not a 1031 exchange. It's also not a Delaware statutory trust, which gets confusing a lot because they're both DSTs. And so most people might think they know it, but they don't, and most of the time. And so, but I want you to think about, Kevin, you're selling a mobile home park for $10 million that you've owned for 30 years, and you own it free and clear. You have no basis left, right? And you're selling it out of a state that's going to be, you're hammered with tax. And so as a mobile home park owner, what can you do? Well, you can carry back paper on terms, right, for a buyer. You can become the lender. Well, that's what a deferred sales trust is as well. The difference is we're not asking a buyer to carry paper, or we're not asking a seller to carry paper for us. We're asking the seller to carry paper for a trust, and the buyer to ultimately purchase the property from the trust. So there's 3 parties that's happening at a close of escrow. There's a seller for $10 million. There's a buyer who has the $10 million in cash or getting a loan, and the trust that comes in right in between and purchase your asset for $10 million and ask you to carry back 100% financing, Kevin, and the buyer to put up all the cash. And so the buyer ultimately buys it from the trust. The smoke clears, and you're left with that promissory note. You're a seller who's carried back 100% financing for the trust. The buyer's gone, and when we do it in that order, the magic happens, which is the investing part, which we can talk about here in a minute.
Yeah, fantastic. And talk to me about why that's better, or I guess give me a comparison to the 1031, like when this might be a better solution than that of a typical 1031 exchange.
Yeah, I'm going to give you the analogy of Blockbuster versus Netflix, right? And if you remember in the olden days, right, you have to show up on a Friday night and get this video, right, that was maybe there, maybe not, behind that cardboard box. But even if you got that video, you have to return it within 3 days. If you didn't rewind it, you'd have to get a penalty. Well, that's like the 1031. The 1031 exchange is very restrictive. You get 45 days to identify, 180 days to close. And I love a 1031 exchange, especially when I can find a deal that makes sense, right? I've closed countless of those over the years, and clients, we give them a high five if they can find it in today's marketplace. But oftentimes, it's creating a sense of what I call a shotgun wedding. And a shotgun wedding, Kevin, for our friends, you might have friends that got married quick, and maybe it didn't work out so great. That's sometimes what a 1031 can do. You can sell high, and then just 180 days later, you're buying higher on a property that perhaps you didn't even want to buy on the intrinsic value of the cash flow, but you're buying it based upon this tax tail that's wagging the investment dog. So that's always the first thing, is what's called optimal timing. Blockbuster is kind of the restrictive way of doing things. And then a thing came out called Netflix, which we is an analogy for the deferred sales trust. And there's no timing restrictions. In fact, the number one reason I started this business was for a case study out of Minnesota for a gentleman who sold a $20 million asset. And we called this the Monday morning quarterback. And this guy hates the stock market. He's done 1031 exchanges worth a couple $100 million at the time. And he's going, I'm not going to 1031 because I don't want to overpay, or I'm going to do this deferred sales trust to defer my tax. But he goes, I'm not going to 1031 because this doesn't make any sense. And this is 2006. And so it's a Monday morning quarterback because he sold at the peak and then he bought back 5 years later at 60 cents on the dollar. And this is how he did it. He put the money into the trust, to 20 million, deferred all the tax, put it into conservative stock market stuff, which I'm not a big stock market guy, but this is what he did because he's like, it's better than paying the tax. And then 5 years later, the bank calls up and says, hey, we just foreclosed on that property. And we're curious, do you want to buy it back from us? And he says, that sounds like maybe a deal, but what's the price? He said 40% less than what you sold the property for. And he goes, deal. So he made the deal with the bank and he reallocated the trust funds into an LLC and he bought it back at 60 cents on the dollar. And my head exploded when I heard this, right? He sold high, he bought low. How can you do that? Well, it's Netflix, right? That's what the deferred sales trust allows you to do if you understand the steps, okay, that this is an installment sale. It's IRC 453. It's not IRC 1031. And if you work with our team of professionals to execute this, you can do this. But most people just A, have never heard of it, B, don't know how to do it, and C, just always just choose Blockbuster until they meet us, and now they're choosing Netflix. So
yeah, no, I appreciate that. And who is the ideal client? I mean, I guess, or the better way to ask that question, as far as capital gains exposure, is there a certain minimum amount to where this strategy actually makes sense, to where it might be cost prohibitive if it's below that number?
Yeah, so it's got to be a qualifying client, and we like to see a $1 million net proceeds, $1 million gain, right? Those are the key things that we like to look at per transaction, unless you have two deals at 500 each that you can combine to make one. Also, remember, 1031 exchanges only work for investment property, right? 1031 exchanges do not work for primary homes. They do not work for cryptocurrency. They do not work for business sales, right? They do not work for captive insurance or artwork or collectibles or public or private stock. So the 1031 exchange, again, is still like Blockbuster, and it's not ideal because it doesn't work for any of those other asset classes. Whereas the deferred sales trust, it works for all of them. I mean, we just closed a $5 million deal for a cryptocurrency client. She worked for Google, and she's in her 20s, and her Bitcoin went from 50,000 to 50 million. And she calls us and says, hey, I want to go start a business but I don't want to pay all this tax. Can I defer the tax and then partner with the trust, like the guy who did in Minnesota, and start a business venture? And the answer is yes. So she exited $5 million at 54,000 a coin. And that's pretty powerful because she would have paid about 1.85 million of tax. So she's got about an extra, 2 or so working for her. And then those monies can go into that business venture with her. And so that's the cool thing. It's kind of like a self-directed IRA in that scenario, but it's got to be qualified. It's got to be big enough. If it's too small, our fees and our costs, it doesn't make sense.
So as far as what type of business that she wants to reallocate those funds out of the trust into, are there restrictions? Can it be real estate? Can it be art? Can it be other crypto investments? Can it be anything, or are there restrictions there?
Great question. So generally speaking, there's no real restrictions. However, the execution of not over concentrating into a single asset class are things that we want to take into consideration. So, for example, before anything went anywhere, she happened to be single, so she fills out a risk tolerance questionnaire. Based upon that, we have a third-party financial advisor that's going to present an allocation, as well as the trustee. Part of my role as well is to overlook and be a fiduciary to her, the note holder as well, to see if it's suitable, to see if it looks good, to see if it's the risk that she's willing to take. And collectively, we're working as a team to say yes or no to certain investments. That being said, it can go into mobile home park funds, it can go to real estate funds, it can go to private, passive or active real estate deals. This particular deal is a tech startup. In fact, it's an educational company for her and her college roommate. They wanted to be starting this for a lot of years, and so this is their chance to do that together. But it can go back into cryptocurrency, but we just don't want to over concentrate or some of the stipulations. If you want to use it for a primary home, it would be taxable, right? So it's nothing that can be like, it's nothing that is personal use. If it's investment use, and you can run that deal and get the cash flow, pay tax on that, then it's a good thing, and it's a winner.
Yeah, fantastic. So that was one case study. And I think that what I'd love to do, Brett, if you're good with it, what I'd love to do is if you could share maybe some other relevant case studies. I think that's a really easy way for folks to better understand the mechanics of it and how this strategy might be applicable to their own situation. Again, given that we're a real estate podcast, you used an example of the Minnesota property, which I love that one. I absolutely love that one. Buy, or sell high, buy low, and ultimately 60 cents on a dollar utilizing the DST strategy. But maybe if you would, you pick a couple examples that you think would be relevant to the listener base, and please give the I guess the challenge, what type of capital gains challenge that seller or the owner of that property was facing. Ultimately, how the DST allowed them to overcome that and I guess defer it, not necessarily overcome it, but defer it.
Perfect. Yep. Great way. I love case studies as well, Kevin. So I'll do one that we just closed just 2 weeks ago out of Denver, Colorado, for a client named Ron Anderson. And by the way, you can hear all of Ron Anderson's full interview of this entire deal. And Ron and his wife are doing really well, and they're owning multifamily properties. They're owning rentals. In fact, they're doing so well, and Denver is such a hot market, they're able to convert their kind of a longer-term rental into a short-term rental. And it's 18 units, and this value and these rents and all of this revenue are just driving the value of this thing. But they're finding themselves in a position like a lot of our clients are finding themselves, Kevin. They're like, you know what? We've got a lot of money, but we don't know how much time we necessarily have. But they're really young and they're healthy and everything. But they're like, COVID thing has caught us a couple things. We want to play more and we want to travel more, and we don't necessarily want to work as hard as we've always worked. And so they said, what's our one of our properties that's causing the most amount of stress? What if we do this deferred sales trust thing, where we can keep our cash flow consistent or even better and get none of the work, none of the headaches, none of the calls, right? It would just lower our stress, right? And so that's what they did. They sold it for $4.2 million. Their challenge was they had a very low basis, and in fact, they had also a debt over basis, okay? So I'm going to tell you about how the deferred sales trust coupled with the Delaware statutory trust solved this, okay? So they're selling for about $4.2 million, Kevin, yep. And their basis, if I recall, is right around I think it was right around $1 million for the basis. Okay. Actually, I think their debt was $1.5 million, and then their basis is right around $500,000. It's pretty low. Okay, because they had 1031 exchange into it, did some depreciation, and so they had about $1 million mortgage over basis. So the first thing we had to solve for is that the deferred sales trust has a limitation and that it cannot defer debt over basis. And so fortunately enough, they have the 1031 option to do a partial Delaware statutory trust. So step one is all of the funds close into the trust. And they first paid off the bank of that about $1.5 million, but then they had about $1 million of debt replacement that they needed to put. Otherwise, it would have been categorized as ordinary income tax. Okay, and so we connected them with a securities professional who did a Delaware statutory trust for them. Now, this Delaware deal, what's interesting about it is they're very high debt deals. And so they create these deals that are typically tenants like Amazon is the tenant, and the whole purpose of this is to replace the debt for people who have this challenge with putting as little equity as possible. And so the equity they put down was about 18% of that $1 million base mortgage over basis. So they put about $180,000 down, okay, of their equity, and that 180 replaced the debt challenge. So now that's off the table. And then the rest of the funds could just move into the trust. Okay. And this is cool. So you can have both scenarios. Now that 180, they maintain ownership because it's a part of it's kind of like a TIC structure, if you will. You're moving into a Delaware statutory trust. But that keeps that from having to be taxed as $1 million. So they were really happy about that. The other amount can go into the deferred sales trust, and this is where they're happy too, because they can be in liquid investment grade securities, but also it can go into passive real estate deals if and when they find those, and they can diversify that, right? So back to 1031 versus for Blockbuster 1031. 1031 Blockbuster is all of the entity must move and all of the equity must move, and typically that means all of it into one single deal. Right? Whereas the deferred sales trust, I can now spread, and in their scenario, about $2.5 million or so in the trust, they can spread it across 5 or 6 different operators and different mobile home parks, multifamily, some cryptocurrency, some real estate, active, passive, and they can lower that stress. So I'll pause there, see if any questions there, Kevin.
No, that's fantastic. I mean, really just, thinking through the alternative, their alternative would have been, again, the standard 1031 exchange. But ultimately what you're saying is that they COVID made made them think a little differently about life, and ultimately have some, probably inner reflection as to, we want to slow down a little bit. Don't want to work as hard. Don't necessarily want to exchange it to another property, right? Like the 1031, it's kind of the, proverbial kicking the can down the road forever, right? Like you got to keep kicking that can, and you really at the end of the day, if you ever stop kicking that can, that's when Uncle Sam comes home to roost. And so they didn't want to keep kicking that can down the road, and ultimately the DST allowed them the strategy to continue receiving cash flow, get rid of the headache property without exchanging into another headache property, which is, again, that's a beautiful thing. I think it's a challenge that a lot of landlords go through at some point in their investing career. Especially more mom and pop, structured landlords that are kind of overseeing their assets. They've got smaller assets that, can't necessarily be handed off to a large, professional third-party management company. And it sounds like Ron kind of fit that role. And so this is a great solution for he and his wife, and will offer them just a ton of flexibility. So I love every bit of that. I guess the other, one of the questions that came to mind was, as far as deciding, you said there's a risk profile or a risk questionnaire that you go through to determine, what types of, risk level they have, ultimately based on how those funds are going to be invested out of that trust. And so do they get to make the final determination of where those funds are invested out of that trust, or does the trustee have the final say in that? I mean, how does that risk questionnaire go into the decision-making process? Maybe they're risk adverse in the beginning, but maybe the risk profile changes, 6 months down the road. Can they make adjustments as to what those funds are getting invested into?
So yes and yes. So none of the funds ever move without their approval or their signature. Now, as well, they also don't move without the trustee, and that's my role, third-party unrelated trustee approval or signature. And it's important to understand this, that the nature of why we're getting all of this really cool flexibility, optimal timing, all the different no like kind requirements, is because we're moving from IRC 1031 exchange or 1031 to IRC 453, which is an installment sale, which means you're changing the nature of what you were, which was an owner, and you're becoming a lender. Okay. And what does that mean? Well, that means you don't own the trust, which can be one of the things that people need to understand and be very clear about. That's also what makes the tax deferral, right? That's why it's tax deferred, because you don't own the trust. But it's not unlike things you might do otherwise, Kevin, like IRAs or 401ks or even a 1031 exchange. Like you're not sending the funds to your own 1031 qualified intermediary. You're sending it to a third-party 1031 qualified intermediary. So our role as a trustee in Capital Gains Tax Solutions is we own the trust. However, all the money's owed to you, and you're the secured lender. You're the bank. So you're not concerned if the money's going to get back, because you have to approve of the investments, right? Of the collateral. So you still have it's called indirect control. You don't have what's called unilateral control, because if you had unilateral control, it'd be taxable. So yes, you have to approve all the investments. The funds that are moved without your approval, your signature. You get 24/7 access to these funds online. That's also why we use a third-party financial advisor to help in this process and this team. Our goal is to build the dream team. So does that make sense, Kevin, on that?
Yeah, absolutely. It does. And I love that case study. That's a fantastic one. And maybe share one more case study if we would, if you've got one that comes to mind, that might be relevant for the listeners.
Yeah, think about the dentist that we helped out in Connecticut, okay? And so he's looking at a big sale on a business, and he's looking at hundreds of thousands of dollars of tax. And this is substantial for him because it's his second business sale. And he's going, Brett, I want to retire, and I want to invest in real estate, and I want to be active in real estate. So I want to retire from the business side of things of being a dentist, but I want to be active in real estate. And so he sold and he deferred the tax, and then he partnered with the trust to go buy an investment real estate property, which was big. And I'll tell you one other one, a guy who sold a deal in Texas, and this is actually one I think I should have brought up earlier with you, Kevin, was he did an assignment. So, some people buy deals on assignment where they tie up a deal like at $11 million, and then they exit and they have a buyer at 15.6, but it's a simultaneous close, right? They don't even have the 11 yet. And so, they have a lender lined up or something like that. Well, that's exactly what he did. So he calls me, he's 2 weeks before closing. He's like, Brett, it's a $15 million deal in Texas. He goes, it's a land deal. I got it tied up at 11. I'm selling at 15. I can't even qualify for a 1031. Can I use the deferred sales trust? And the answer is yes. Wow. And so that $4 million arbitrage, if you will, right, was able to go into the trust, and he's to defer all the tax versus getting hit with ordinary income tax, which is huge, right? So that's the other thing, too, why we're like Netflix, is we can work for scenarios like that.
That's powerful. I never even thought to ask that question, but that's incredibly powerful. So for an assignment, does it have to be a simultaneous close, or anyway, we don't have to get into the mechanics of that, but just knowing that it works for an assignment type deal.
Yeah.
And so that's a beautiful thing. Gosh, there was another question that came on, but you just caught me off guard with that example or that case study, because I was not aware that it could be used for that type of strategy. Yeah, obviously the typical assignment, that model is more common with, wholesale, like single family wholesalers, where, they're not having, multi-million-dollar assignment fees, or maybe, $5, $10, $15, $20,000. So that wouldn't be a relevant strategy for them. But in this example, which I think is probably it's happened a lot over the last couple of years, tying up a piece of property, land is just at an all-time high demand with these tract builders that are looking for more land to expand upon. And I've actually heard of many case studies where, again, tying up a piece of entitled land and ultimately flipping it to one of these large home builders like a Pulte or anyway, I can't think of any of the names of the building companies, but anyway, now I'm rambling, but so let's get back to the topic of discussion, the DSTs. I love that case study. For those that are interested, Brett, I mean, that want to learn more, I mean, what does the process look like? So they're in a scenario where they're considering selling a property. What are the next steps they take to make a determination whether or not this is a legitimate strategy for them?
Yeah. So first of all, we do everything at no cost, no obligation, unless the deal closes, and for any reason it doesn't close. You don't use the trust. You don't owe us anything. So we work on a conditional basis with the tax attorneys. But it is important that you set it up prior to the buyer removing all contingencies. And also realizing that there's 1031 exchange companies that don't want you to know about this, Kevin. And there's some 1031, there's some commercial real estate brokers that don't want you to know about this. Okay. In fact, at Marcus and Millichap, that was the story. The first manager brought in a gentleman, my business partner now. He was the manager of the office. He brought him into Marcus and Millichap, and he was like, check this thing out, guys. He was totally open-minded. He ended up getting let go a couple of years later, and then the next guy came in and told everyone to stop talking about it. And you're like, what do you mean? Like, this could have saved them all this money. So this weird dynamic there. But the point is, realize that a lot of people don't want you to know about it, but you can know about it, and you can have them do due diligence with us. We want to bring them on for the ride and bring them into the family, right? And they end up joining us. So step one is just simply getting with us, right? Step two is let us x-ray the deal, the purchase and sale agreement, or prior to even listing the property, getting with us so we can make sure everything's in order. And then we form the trust. And then, we talk with the financial advisor, get the financial advisor plan in place, and the tax attorney works with your M&A advisor or your commercial real estate broker or escrow. We work behind the scenes to make sure everything is set up properly. But then at the close of escrow, the funds go to the trust. So that's the main thing. We have our mastermind you can attend every Friday at 1 p.m. Eastern, 10 a.m. Pacific Standard Time, where you can check out and hear from live clients actually that come on there. We have clients about every other week they're coming on, and they're still learning about it, and they're sharing their story. So those would be some of the main things. I also would like to touch on two other things real fast too. So we did another deal in San Diego, Kevin, for $12.75 million that just closed last week. It was a hotel sale, and it was 3 partners. It's actually 4 partners. So 4 partners that are selling. 3 elected to do the deferred sales trust, and 1 did not. And this deal literally happened in 2 weeks. Like, the guy found out about it about, T-minus 15, 16 days before close. And like we went to hyperdrive mode or emergency room move with all hands on deck. And we just closed on Friday. But one of the partners, he was 20%. He just wanted to pay his tax, which is totally cool. Like, you can, if you want to have one partner pay tax, the other 3 elected to use the deferred sales trust. There was one single trust for each family unit. So they deferred all the tax. So they're really happy. And the other thing is the 40% death tax, right? So the other thing that we need to really be aware of is that there's people that are worth more than 22 million married or 12 million single, and those exemptions are set to cut in half by 2025, which means anything above and beyond that is subject to a 40% death tax, which has nothing to do with drop and SOP 1031 stepped up basis. Mm-hmm. That's just capital gains tax. Death tax is a whole nother animal. It's the elephant in the room that's at 40%. And so if you're worth more than that, and that's inside your taxable estate, and you pass within 6 months, your kids or whoever's taken over the estate needs to pay that, right? So what's cool about the deferred sales trust, we call it 2.0, is you can move it outside your taxable estate and eliminate that estate tax, which to me is like huge, because there's $32 trillion that's going to pass from one generation to the next. That's the baby boomers. That's our parents, Kevin, to us in the next 20 years. And so how do they get it out? Well, they need to exit as number one. It needs to have a sale. And number two, they need to have a deferred sales trust 2.0 set up prior to, so we can get it outside the taxable state. We just did one in Colorado for a client. There were $25 million. They sold a $5 million multifamily property. And that's the main reason they used the DST. They said, Brett, we had all $25 million in our taxable estate, and they're young, and they're like, this is going to probably be worth $50 million by the time we die. So let's get it outside the taxable estate. So these are all the things that we're doing every day to help people make a decision on it.
I love it. I think you giving that one example, not that one, but the one prior to that about the time crunch, the sale of the hotel with the 4 partners. I was going to ask you, how much time is needed when a client comes to you and says, hey, I'm selling this property, assuming that this could be a good strategy for them. I mean, can this be thrown? This truly can be thrown together and put together in 2 weeks or less, it sounds like. If
yes.
Need be. I'm sure you'd like to have some more time than that, but.
So yeah, great question. So, 2 ways to answer this question, right? So the first thing is I asked him is, has the buyer removed all contingencies? And he says, no, he had not. I'm like, beautiful. We can still work in this first time frame to set this thing up. However, guess what happens, Kevin, when you meet somebody on YouTube or a podcast for the first time on a $12.75 million sale, that your partners, and one of them is your brother. And I mean, there's a lot of emotion, and there's a lot like, oh, who are these people, right? Oh my gosh. Like, we thought these guys are smart guys, 12.75, and they have multiple properties, right? So these are not, it's not easy to squeeze that know, like, and trust within this small window. It's part of why I love it, because it's like the fourth quarter, and you got the game on the line. Like, it's super challenging, but we were able to get the team, all of us coming together to give all the references and everything else. So yeah, so there's the emotional part, there's the actual legal part. So the legal part we can do we can form a trust in 24 hours, we can set up the bank accounts in another 24 hours, and we can close deals in 72 hours, right? Like, we can do it really fast. That's not really the aspect, but it is the emotional part of the CPA who's the skeptic, the brother-in-law who says it's illegal, these guys are going to take all your money, all of the other stuff that's down there that we overcome, hopefully by our YouTube channel and our podcast and by our book, by the way, which we have some smart people like Kevin Harrington from Shark Tank's going to be in the book, right? And we were trying to make this a household name because we believe that everyone deserves the right to exit well, whether you're a millionaire, right, or whether you're selling your first property or your first business or crypto for $1 million. And you deserve to exit in a smart tax-deferred way and take advantage of what's out there. But without the right people to help you, you're going to be left, paying the tax or, maybe not selling.
Fantastic, Brett. How do folks reach you, learn more about what you have going on? I know you've got the podcast, so they can go search that on wherever they listen to podcasts, Spotify, iTunes, what have you. You've got your YouTube channel. But go ahead and why don't you go ahead and share, the website or the best way to actually track down everything you've got going on, because you got the book as well. You got a lot of resources out there available to folks.
Yeah, so capitalgainstaxsolutions.com is the best place. And you can also search Capital Gains Tax Solutions on YouTube or Instagram or Facebook or LinkedIn. You can also just search my name, Brett Swartz, and I'd love to connect you with all the social media. And then again, look for the actual, I said the name of the book. The book title is called Building a Tax Deferred Exit Strategy, and it's the proven playbook for unlocking your ideal wealth plan when selling assets of any kind for yourself or for your clients. And that's coming out. And there's other really smart people like Kevin Bupp is actually in the book. He's got a chapter in the book, which is awesome. And we've got another guy. If I could end with this one, his name is David Young. And David Young is the founder of Anfield Capital, and he was a former executive vice president with PIMCO. And like a lot of people out there that are skeptical, and if you're hearing this, you should be skeptical, by the way, of me and everyone else who tells you about some tax deferral strategy that you've never heard of, and it's going to be your multi-million-dollar sale. You should ask a number of questions. And David worked with a guy named Bill Gross, and these guys ran PIMCO, and 4 other guys from $80 billion to $1.2 trillion, and they are some of the smartest in the world, manage some of the biggest wealth in the world. And about 4 years ago, David and 4 other guys get approached with the deferred sales trust, and they're like, what is this thing? Like, we never heard of it, but they were open-minded. And they did a 2-year due diligence on us and their legal team and on the clients and all the stuff. And they flew back to the Midwest, met with the tax attorneys or my business partner, everything on a whiteboard, and they came through with 2 conclusions. Number one, that might be the smartest person we've ever met. And I don't know if I said in the beginning, but he's like the Bill Gates of tax deferral. Yeah. He's my business partner. He's brilliant. And number 2, we're all in. We'll put our name on this thing, right? We will manage the money for clients for the DST, and we'll be a part of the inner circle. And so I always say, if it's good enough for David Young, and this is his chapter right here, he tells his whole story of overcoming false beliefs with the deferred sales trust. Is it good enough for Kevin, Brett, and whoever's listening to this? And that's really our goal. Is we want to help people unlock what's possible with tax deferral by bringing in literally some of the best in the world who've looked at this, and giving you a chance to connect with them and talk with them and vet us, so that you can exit without having to feel, trapped by capital gains tax.
I love it. Brett, when's the book coming out? I know that it's launching soon. So when can folks expect to find that on Amazon?
So the publisher and me, we were ready to go. We're just finalizing like literally one chapter. And so I would say in the next 30 days, look for it on Amazon. But it's so let's say May 20th. Let's say that's the date, okay, Kevin.
And if it's not there, guys, set your reminder. Keep checking back, because you're going to absolutely want to get a copy of the book. So no, we're launching a book as well, Brett, and these things get pushed back here and there, and so ultimately I understand very much what you're going through. So, but congrats on the book. It's awesome. It's done. It's ready to rock and roll, and you're going to help tens of thousands of people. So absolutely love every bit of it. Guys, Capital Gains Tax Solutions.com. Go to the website, go to, subscribe to the podcast, there's YouTube channel. I mean, Brett, you just got a lot of awesome information out there. So thank you for all that you do to help all of us defer capital gains, which again, those that are writing that big check, right about this time to Uncle Sam, there's another way. There's a better way. So my friend, thank you again, as always. Tell the family I said hello, and look forward to staying in touch, and keep doing what you're doing. You're doing awesome, my friend.
Thank you, Kevin. Will do. Take care.
Alrighty, guys. That's all we have for this week's show. So until we meet again next week, this is your host, Kevin Butt, wishing you huge success. You take care.